What's up, everybody? Welcome to Heresy Financial. My name is Joe Brown, and today we are looking at the one asset class that I would invest in if I could only choose one single investment for the next 10 years. Now, fair warning, it is probably not what you would expect me to say. Ready? Let's dive in. All right, guys, so let's lay out the ground rules here so that you understand why I picked this asset class for this thought experiment, because ultimately that's what this is. This is just a thought experiment because nobody's ever locked into choosing one investment for the next 10 years and having to put all of their money into that and not being able to sell it at any time over the next decade. But that's what we're doing here for this hypothetical situation in this video, just so that you understand it's a good way for me to communicate what I think the massive impact and the massive growth that will happen in this asset class for the next decade and potentially even longer, probably even longer actually. So the ground rules: I can only have an investment in one asset class and I can't diversify into other asset classes. So I can't choose, like, I can't have cash or gold or Bitcoin, on the sideline unless that was the asset class that I was choosing here. So in this situation, you'd be looking for something that would have the greatest chance, the highest probability of outperforming some of the things that you think will perform well over the next decade, potentially cash or gold miners or Bitcoin, even a benchmark stock portfolio or real estate. So you'd be looking for an asset class that had the greatest probability of outperforming any other asset class that you might be choosing here. You'd also want to be looking for an asset class that has the least probability of underperforming and least probability particularly of having a giant collapse or a crash or going to zero. And again, you're only investing in one thing, so you can't diversify out of that asset class. You can't offset potential losses with uncorrelated bets, which is something that I always preach here on this channel. I always talk about how your investments should be non-correlated. That's what true diversification means. Similarly, you would not want to choose a lottery ticket item, something like I view Bitcoin a lot like a lottery ticket, simply because of the odds historically for thousands of years. Every time a fiat money system has collapsed, people naturally resort to using gold instead. And that's happened for thousands of years throughout history. And so the likelihood is that that happens again, that gold comes back as, we have another gold standard globally again. Now, it's possible that Bitcoin is the next global reserve currency, in which case, in my actual investing portfolio, I think there's definitely room for that. It's more of a lottery ticket item because odds are it goes to zero, but in the chance that it does become money, the payoff, the reward, minimum 30, 40x the amount of money that you put into it. But if you are restricted to investing all of your money into one asset class for the next 10 years, you would never want to choose something that has any probability at all of just going to zero. Now, on the flip side, you also wouldn't want to choose something like gold, which might come as a shock, and it's obviously not the asset class that I'm choosing here for the next 10 years in this thought experiment, because with something like gold, you might gain a little bit in purchasing power from a collapse in the paper markets, the futures markets on gold, with the fractional reserve system that they have on gold right now with unallocated gold, keeping those prices low. So you might gain a little bit in purchasing power from that, gain a little bit of purchasing power from technological deflation, but it's not by itself going to make you rich. The reason gold has a place in a portfolio is so that you have dry powder, so you have purchasing power when other asset classes inevitably go on sale over the next 10 years or so. But if you're restricted to one asset class, you won't be able to utilize that gold for that opportunity. You just be stuck with holding that gold for the next 10 years, so it's out of the window here. You also wouldn't want to choose something like gold miners, which is probably what most of you were expecting that I would say, but precisely because with gold miners, what you have in cycles like we're seeing to start to happen right now, you see a big bubble form and you see massive amounts of money run in, especially as these companies get massively profitable from the price of gold going up. These companies get very, very profitable, and then all of a sudden, all that money, new money that's been printed and shoved into the system, it's looking for yield places. So when all this money realizes that there's a massive amount of profit potential, a massive amount of yield available in gold miners, all that money is going to rush in. It's going to push it up. You see bubble dynamics happen with gold miners over and over and over again. In addition to that, so you might make a lot of money in the short term, but then you with bubble dynamics, you always see a crash following that. And so it wouldn't necessarily be the best bet for the next 10 years because you wouldn't have the opportunity to get out. Similarly, gold miners they do really well in the beginning stages of the gold bull market, but they're negatively impacted by inflation as well because their energy costs, the costs to produce and to refine and to drill and oil and energy and all of that, their costs will go up as well. Most of the time they don't go up as much as gold, especially in the short term, but long term things tend to revert to the mean. If they become so profitable that expands the incentive, the financial incentive to explore more and to start drilling into mines where there are deposits, but they haven't had any drilling yet on them. And so because of that, miners are more of a thing where you want to be able to have the capacity to move in and out as you see these dynamics unfold. It's not necessarily something you just want to buy and hold and close your eyes and walk away from for 10 years. So if all of these are out the window, what would I choose for the next 10 years? Emerging markets. Now, emerging markets are something that I haven't really talked much about on this channel, but if I was forced to put all of my money into one basket and not touch it for 10 years, I would place it into emerging markets. There are three big reasons why. Number one, de-dollarization. Number two, the fundamentals. And then number three, the trends shown by the technicals. And so we're looking at de-dollarization first, and this is the biggest driver as to why I would place my money in emerging markets if I had to for the next 10 years. Many emerging markets countries are currently and have for a long time been crushed by dollar dependence globally. Most global commerce around the world is denominated in dollars. And so if the dollar fluctuates versus their local currency, that can be devastating to a lot of these countries. But the good thing for these emerging markets countries is that the world is de-dollarizing. The world central banks all around the world have been dumping treasuries. Central banks all around the world have been buying gold. Global allegiances and political affiliations are changing around the world, whether that's good or bad globally or for the States or for China. Not talking about that right now. What I'm talking about is the benefits that it will bring to emerging market countries. And it is undoubtedly good for the economies of these emerging markets. De-dollarization is something that will bring massive wealth, massive growth potential, massive growth opportunities to these countries. Many of these countries already have a lot of gold, and so as global political affiliations change and the world is less dependent on the dollar and more contracts between international contracts between countries are denominated in currencies other than the dollar, there's more of a chance that many of these countries would want their contracts to be denominated or settled in gold. And even if not, it would be over a basket of currencies. International settlement would be done with a basket of currencies, and the dollar's place in that would would become a lot less. Currently, the dollar makes up somewhere about 90% of all global transactions, but the United States GDP is much less than that. It's like a quarter of the world's total GDP. And so the amount of involvement that the dollar has in global transactions is far more than it would deserve if you look from a GDP perspective globally. And so especially as China's rise continues to advance, and with their Belt and Road project, they're creating a lot of political affiliations and commercial affiliations, building infrastructure all around the Eastern Hemisphere. As that continues to take off, more and more of the world will want less and less involvement with the dollar. That's been happening, and it will continue to happen to a greater degree. If you travel to Africa 10 years ago versus traveling there today, many of the countries in Africa look like completely different places. 10 years ago, 15 years ago, you would go to Africa, many countries in Africa, they would look like what you would kind of like imagine you would see on something like National Geographic, like villages and huts and deserty, not developed at all. You go there today, and many of these places, like especially in like Kenya, Nigeria, they're cities, just massive cities, full-on infrastructure, and most of it has been completely funded and built by China. And this is Africa, and so China's influence has reached all the way there, let alone everywhere in between there, especially all over Southeastern Asia, all over Central Asia. And so as this continues, and it doesn't look like this is slowing down whatsoever, this looks to be more and more beneficial to these emerging markets. And the main reason why, again, is the de-dollarization, because the volatility of the dollar and the manipulation of the dollar by the Federal Reserve and the over reliance on the dollar by GDP globally has been detrimental. So as the dollar gets removed, even just from the Eastern Hemisphere in terms of commerce, and it has a smaller and smaller percentage that it makes up, this will be more and more beneficial, provide more stability to these economies, which will provide them greater growth opportunities. Now, the second reason why I am so bullish on emerging markets for the next decade and longer is because of fundamentals. Now, demographics, you've heard me talk about this a lot, but demographics are the number one driver of growth by far. And so when you look at specific cities, right, you see nationwide, like I've talked about real estate, how nationwide in the States looks like housing prices will continue to go up, but you're going to have pockets where it collapses, like San Francisco is happening right now, New York City, that's happening right now, Chicago. So there's a lot of these places where people are just fleeing. Demographics will trump everything. So demographics will drive that. And there's other places where, the opposite is happening, where there's, just a flood of people moving in, and that's driving prices up. But nationwide, we still have the demographics issue from a real estate perspective in America. We've got the, too low of a supply, and there's not enough new inventory being created to meet the demand. So that is the number one driver right now. And for decades, just now, not real estate, but just from a growth perspective, demographics has been the number one reason why America has outperformed for so long, because there have been so many people coming here. Immigration has far outpaced just the natural birth rate in America. And so that's why we've had a lot of the growth that we have had. But as that has been changing for a while, that pace has been slowing down, and it looks like that will continue. People go where they're treated best. Nobody's going to immigrate to America if it's worse than where they're living. From a tax perspective, from a regulatory perspective, from a freedoms perspective, from an investment opportunity perspective, starting new careers, whatever the reason is that has driven a lot of immigration to the States, a lot of that is changing, and that could reverse on a dime. And people go where they're treated best. They're not going to keep on immigrating here. Again, like I said, if it's worse than where they're leaving from, if they're going to immigrate to somewhere, leave their home country, they're going to go somewhere else instead that's going to treat them better. And so the demographics driver in America has been mainly immigration. Our birth rate in the States is not anywhere near what is needed in order to support the growth that we've had. But that's not the case in many emerging markets countries, especially in places like India and all over Africa. The populations are extremely young. The populations have lots of gold. They store their wealth, and they know how to do that in ways that are stable. The populations are not as reliant on the government and handouts and stimulus. The economies are in their birth stage. They're in their infancy stage. There's lots of natural growth that's not dependent on immigration. And the same things that we've seen unfold in China for the last 30 to 40 years, we're seeing the beginning stages of those start to bloom in a lot of these emerging markets countries. And finally, the technicals, which, like I said before, and this is why I saved it for last, because this is, the one thing that a lot of times people look at and they say charts are voodoo. Well, charts are just visual representations of fundamental patterns. And so everything that I've been talking about here, the tide changing as America decreases, the rest of the world increases, you can see that starting to happen and unfold visually in the charts. So we're going to kind of go rapid fire through this, because a lot of the benefit that you get from looking at these is just to see the general trends. If you look at this first one here, you can see this is a log scale of emerging market equities, and this starts in the 50s, goes through today. You can see for a while now, ever since probably the last 15 years or so, they've been consolidating and just building and building and building, ready to explode to the upside of a channel that they've been in for decades. Now this one, the MXEF index, you can see this is a close-up of the last 15 years. And this energy, it's just been coiling. This is consolidation. Like a spring, it is getting ready to explode. Even over the last few months now, if you look at this chart zoomed in here on basically 2019 and 2020, you can see that it looks like this trend, it's starting to bottom out here and reverse and start to head back up to the upside. If you look at this chart, you see the white line is the emerging markets versus the S&P 500 relative value. year-over-year percent. And so that white line is a fluctuating line. It shows the kind of the trend and the cycle. And the blue line is inverted, the dollar inverted. And so you can see that these two follow each other very closely and kind of have this trend. And we're at the bottom of this trend. Reversing should be something that we see start to happen soon. And this is long term, right? This is 40 years or so here that we're looking at. And so we're looking at the beginning stages of a long-term bull market in emerging markets. So really, these are visual representations of patterns that have been building for years and decades, showing that emerging markets are poised for some explosive growth over at least the next decade. Now, obviously, a question that is going to come up here is, well, how do I invest in emerging markets? And it can actually be very difficult, despite what you might think. A lot of times in a lot of these countries that have the best potential for growth, it's very difficult to get capital in. There's not the same amount of liquidity. There's not the same number of publicly traded companies and exposure to the economies overall. And so for the average investor, my favorite way to get into emerging markets is simply an active mutual fund. Now, the growth in emerging markets is likely to be so great and so widespread that even just a few regular run-of-the-mill emerging markets ETFs will probably do very well and probably outperform most asset classes over the next total 10 years. But simply because of the difficulty of getting capital into some of these countries that have the best opportunity, that's one of the reasons why I like the active mutual funds, because you don't have an index that's arbitrarily assigned certain weightings to certain countries and regions and markets. You've got active managers who are looking at long-term trends, deciding where to allocate capital. Many times there's red tape and loopholes to jump through and difficulties, hurdles to overcome to get capital into these countries, and active managers are a little bit better at overcoming that in some of the areas where they really want their capital to be invested for their fund, versus something like an index fund might pass it over or invest in it in a less efficient manner. Now, like I said at the beginning of the video, this is more of a thought experiment, because I would never, and I am not putting 100% of my capital into one specific asset class. But if I had to, this is where I would put it. I think there's a huge opportunity over the next 1 to 2 years to make a lot more money short term, investing, timing the market a little bit more, investing in things like gold miners, keeping some capital out of the system in gold, allocating a little bit to Bitcoin. I think there's a massive amount of money to be made short term in that, and then deploying that into emerging markets as these trends get going, I think is going to be a winning strategy for years. This bull market that we're starting to see begin in emerging markets is getting started now, and there could be some volatility over the next couple of years. There's volatility in giant bull markets regardless, but it's only going to get stronger as it goes. And so personally, I feel like there's more money to be made by doing a little bit of timing over the next 1 to 2 years, and then through that allocating more and more capital to emerging markets as time goes on. I think there's more money to be made doing that. But if all you were going to do is pick one asset class and stick to it for a decade or longer, emerging markets is where I would be putting my money. As always, none of this is advice. It's meant for educational purposes only. So I hope you enjoyed it. Hope you learned something. And as always, I really appreciate you guys. You really are the best. Have a good day.